Welcome back to the Max Your Dash podcast. Thank you for listening, liking, and sharing. We are back again for the first podcast episode of 2024. I'm here with my co-host, Nate. I'm Steve. Mark is here for the first episode as well. What's going on, gents?
Okay. What is going on? It's Friday.
Yeah, it's Friday. It's the 5th. Me and Nate been a little under the weather. Mark is the picture of health, apparently. Can't get sick.
I've been doing sauna, cold plunges, taking all kinds of vitamins. And
I'm starting the Max Your Health podcast next week.
Max Your Health. You think we could get Gary Brecka on there?
Dude,
I'm just going to disagree with him the whole time. And we're gonna have him sit where you are. Nate's right there. Nate's following the Gary Brecka protocol. Yeah. I'm following my protocol.
Someone make this make sense.
I'm not sick.
You're not sick. Oh, yeah, this stinks, man. He's gonna tell us to get the blood work.
Get a genetic test. Get your blood work done.
This is perfect. Max Your Dash moments of the year.
Yes.
What was your 2023 Max Your Dash moment? If you're new here, Max Your Dash moments are the moments we were feeling true joy and fulfillment. We usually do this at the start of every podcast. This is going to be our favorite moment
of 2023.
Of 2023.
Wow. Mine's so easy. I bought a hunting property. That was like a 20-year vision that finally happened.
That is pretty big.
I cried when it happened. That's mine.
You cried?
I cried a little bit.
That monthly payment that he's doing on a hunting property goes for my Max Your Dash moment, which is we've got a second kid coming next month. I also cried. I don't know if it was happy.
You cried too?
Yeah, he's thinking about daycare.
But instead of having a property, that's just daycare costs. It's cool.
That's crazy.
It's fine.
If you're listening to this and you're like trying to make
more... Can you picture Mark as a girl dad?
No.
I told him. New me this year.
Wow.
If you're listening to this, I think and you're trying to make more money, there's got to be a serious opportunity to just like start a daycare, like do something. It's so,
seriously.
It's crazy. It really is like over $1,000 a month.
Mm-hmm.
Insanity.
Per kid.
Yeah.
Do they like feed your kid while they're there?
Not mine.
What do they do? They just let it out?
They teach them. Yeah.
Do they teach like stuff?
Yeah. It is beneficial for that, for sure.
Oh, there's like curriculum?
Yeah, but also like just learning good social skills, like how to behave with other children.
Yeah.
Hopefully behave.
But then you just get sick.
You get sick a lot. Yep. Building that immune system. You know. What was yours?
I don't know.
2023.
Dude, I really don't know.
This was your idea.
I think it's a great idea. I don't think I have a year. That's kind of bad. I don't have a year-defining moment.
How to play piano?
That's messed up. We had an episode on this. You got to have a year-defining
I know we did. That's why this is bad. Maybe I got to cut this part out. I don't think I have like a year-defining moment. Like the biggest thing that happened in my life was my sisters had more kids. That's great, but no, yeah, my family has expanded, and I'm a godfather.
Nice.
My sister asked if I could be her spiritual guide. Pretty big deal. Imagine me being a spiritual guide.
Yeah.
All right, this is to 2024 Max Your Dash moments. Let's have a lot of them.
Yes.
Be more intentional about it. What are we talking about today? We're talking about the year in review 2023 stock market. If you want to know what happened in the stock market, economy, real estate in 2023, this is your episode. We're going to talk about it. We're going to act like we know what we're talking about, which we do.
Yep.
So nice little review. We're going to go over some charts, a little bit educational. Maybe we'll do a little look ahead to this year too.
It was a banner year, I'd say. Wouldn't you say?
Yeah. Surprisingly.
What a contrast from 1 year earlier.
Well, what we thought going into 2023, right? Everyone was scared. It was very cautious.
Interest rates were on the rise.
When was the first interest rate hike? Was it in 2023? Was the first one in 2023?
No.
2022?
2022, right? It was like 10 straight quarters or something of rate hikes.
It's been that long.
Yeah, I think it definitely was 2022 started.
Really?
2021.
I can't remember.
Actually,
interesting.
I think there's a chart in here.
So I think the theme is that like people were really cautious and the year was really good from a return standpoint. If we're just talking about returns,
Yeah.
Why don't we talk about returns, Mark? What did the indexes return in 2023?
Yeah, I would say that it couldn't have been anyone. I mean, I guess us included too. Couldn't have been more wrong about this. What was going to happen this year?
First rate hike was 2022.
It was. Okay. So, thank you to quarter four, which was where a lot of the returns actually came from. Every index finished way up, way above normal. Which one do you want to start with?
The S&P.
The S&P was up 26% last year. Quarter four, 11.69. So almost half in quarter four.
Jeez.
This is one's pretty good, pretty quite wild. Dow Jones was up 16%, up 13% in quarter four.
Wow.
The Russell 2000, so small caps, up 16.9%, 14% in quarter four.
Oh my gosh.
And then you get into the international developed markets, up 18% on the year, 10.4 in quarter four. Emerging markets up 10 on the year, 7.9 in quarter four. And then NASDAQ, a little bit more consistency throughout the year, 44% year to date, finished up 13% in quarter four.
Were any of the major indices negative at all during the year?
No.
Wow.
And I think it's important to point out like how it was literally the opposite of 2022, basically.
Mm-hmm.
Like NASDAQ was down 34% in 2022, and it was up, 44 you said?
Mm-hmm.
S&P was down 20 in 2022, and it was up basically that, right? And every asset class in 2022 was down.
Yeah.
Fixed income was down. Every stock class was down. So it's like literally flipping it over.
Dude, this might be, we'll get into this, but I think...
hold on, there were two sectors that were down. Utilities and energy, which were up massively
in
last year.
This is the perfect 2-year time frame example of why you shouldn't time the market.
Yeah.
End of 2022, what were investors thinking? This is terrible. This is scary. I don't want to invest anymore. Imagine if you took your money out or you stopped investing this year.
Right.
So here, Steve, over the last 3 years, what's done better, the Dow Jones or the NASDAQ?
The NASDAQ.
The Dow Jones has outpaced the NASDAQ by 13% over the last 3 years.
And when you say NASDAQ,
Really?
just so you guys know, the NASDAQ is just the indice for pretty much the biggest tech companies.
So I feel like we've gotten, I wouldn't say we've gotten peppered with that a lot this year, but there's got to be a lot of investors out there like, why wouldn't I just buy the NASDAQ, Well, there's proof right there. Yes, it was a very exciting year and it outpaced by 20% on the S&P, but over the last 3 years, the S&P is up 15% more than the NASDAQ.
Yeah.
So,
And we're not saying anything bad about the NASDAQ, by the way, but this is just good reason for diversification.
Yeah.
Yep.
I think that's a great point you bring up, Steve. It's like the perfect example of something we talk about on this podcast all the time about how hard managing your ego and your behavior is when it comes to investing. And it's just like, I feel like I say this all the time. It's like whatever you thought was going to happen, probably the opposite's going to happen.
exactly.
Like even us as professional money managers, we manage a lot of money. In January, we were very cautious, right? And we were completely wrong. And so I'm fine with admitting that. Like, it's, no one knows it. If we could predict, if anyone could predict what's going to happen, they sure as hell wouldn't be sitting here talking to you right now. Right. This podcast, you'd be the largest money manager on the planet, and you would probably be retired and not doing anything.
I guess for the year in review, when we tell you why everyone listening, why everyone thought 2023 was going to be a bad year was, 2022 wasn't great, but usually historically the stock market doesn't perform well during interest rates hikes because it usually hurts the economy, hurts the consumer, and then everything trickles down. So everyone was like, okay, 2023, these rate hikes are going to keep going. The stock market's going to fall. It was already bad in 2022, and they kept hiking, and the stock market has not fallen.
Yeah.
So that's why everyone was surprised.
Steve, maybe you can get this on the episode on that 2023 charts from Y Charts. The page 19 shows the rate hikes going back to when it started, and just the speed that they were going up is why everyone was so bearish, right? Like it's how can things function well when you're raising rates that fast?
Right.
And for the average person might not really understand how it connects to like business. Like, why is it that the Fed rate impacts so much of this stuff? The easiest way to think about it is like, if you were to go buy a house, right, everyone knows how different mortgage rates are now than they were 2 years ago. It's the same thing with business loans, right? And businesses operate with loans and debt. Like, that's how businesses have to operate. So the interest rate impact on every business is big. So to see the rates going up that fast going into January 2023, it was, it seemed kind of obvious, like, oh, this is going to be another tough year, but it was the opposite. So.
Right. Well, and in how is the consumer spending too? Like, they raise rate hikes so people stop spending, so inflation comes down, and that's why businesses are hurt too, because the consumer should stop spending, and that's usually what happens. And didn't really happen that much.
Yeah, because they had so much money saved up.
Right.
Yeah.
So what, Mark? Why was Q4?
Yeah, I was going to ask that.
What are the experts saying?
Probably because Q3 was so bad. Honestly, like,
did it have anything to do with the Fed saying they're going to do rate cuts in 2024?
No, they didn't say that until just recently. That was over what was that, in December or was it November?
It was in November.
Yeah,
I think.
So I mean, yeah, a big move in December certainly probably was caused by that, but it had already started. The month of November was also a really, really big month. But like, we were talking about how everyone was wrong, including us, about this year, or 2023, excuse me. Here's 2024. We're going in, it's January 5th and we're recording this. Looking at the top 20 strategist projections for 2024, the highest projected from Oppenheimer and Fundstrat, 9.1% appreciation on the S&P. The lowest from JP Morgan, down 11.9%, and the average is 1% gain.
All over the place.
They have no clue. The range that's a huge,
Dude, if you go back and look at every major bank's prediction of where the S&P 500 was going to be at the end of 2023, they were so wrong.
Yeah.
These are the major banks that are supposed to be like the experts and have the pulse on this stuff.
So First Trust, who we love, they're great. They were rated the number one. I can find it in here, but most accurate predictors or whatever projectors for 2022. They projected a recession last year and a really bad year in the markets. Obviously, they were completely wrong last year. They were in 2022 rated the number one forecaster. 2023 couldn't have been more wrong.
Yeah.
And then you look at the Y chart side of things, and there's a 51% chance of a recession next year.
Yeah.
No one has a damn clue.
Yeah. Flip a coin.
Yeah.
That's how you figure it out.
That's why you have to have a plan.
I also wanted to, so you were talking about how the market did in 2023. I always like looking at some longer rolling periods. As of the end of 2023, roughly, this is actually through, I think, November, but the S&P 500 and 5-year total return right now is 12.5%, and 10 years 11.8%. And that's annual average. So even with like what happened in 2022 and the COVID crash, these compounding rates over the last 5 or 10 years are really good. Like, when we model, any client that's listening probably knows this, when we're modeling like your retirement plans, we're probably assuming like a 7.5% average growth rate. So, you could see a 10-year growth rates are still above 10%.
Right.
So kind of crazy.
Oh, I found it. So 200 economists around the world. First Trust is rated number one. Again, we're not trying to bash them, but this is just to get the point across. They had projected the S&P 500 to finish 2023 at 3,900. Where'd we finish? 4,770.
Wow.
Off by quite a bit. Number one forecast.
a lot.
Yeah, that's great.
That's interesting. Okay, stocks. Great year. No one thought it was going to happen.
Yep.
What was the tail of the tape on bonds and fixed income this year, Mark?
Same story, maybe even more significant for quarter four. Okay, so U.S. Ag finished up 5.53% on the year. Quarter four, 6.82%. U.S. corporates finished up 8.5%. Quarter four, 8.5%.
Right.
Year to date on the municipals, 5.78%, 7.4% in quarter four. And then high yield finished up 13.44%, quarter four, 7.16%.
And again, prior to 2023, the tape on fixed income was you can't hide there anymore.
Right. Right.
Well, there was a massive move in Q4 in the 10-year.
Massive.
Which
So as soon as the market started pricing in these cuts way before and way more aggressively than the Fed even said,
Can we talk about that for a second? By the way, the pricing in the cuts thing, it's so wrong all the time.
They priced in twice as many as the Fed actually said they were going to do.
Right.
Twice.
And now I was reading this morning, they were pricing in 4 cuts in 2024.
Mm-hmm.
And now it's it went from an 83% probability of a cut in Q1 to a 50, in a matter of a week or two.
Yeah.
What is that?
It's ridiculous.
No one knows what's going to happen.
The market just keeps bad. They didn't learn their lesson because was it 2022, maybe 2021 and 2022, just the market kept betting against the Fed, basically saying they're not going to keep going higher. They're done raising. They kept going higher like they said they would. And people got burned in fixed income. The only positive fixed income asset class over the last 3 years is high yield. Everything else is negative over the last 3 years, and that literally has never happened before.
Mm-hmm. Mm-hmm.
So pretty wild.
Yeah,
but I do think bonds are acting more of a true diversifier now, a nice safety haven. Yeah. And you're getting paid to actually invest in them. Mm-hmm. There is an alternative, which is nice. You don't have, this is proof here, you don't have to just sit in cash or money markets. Bonds ended up finishing the year quite a bit better than cash. So
yeah. By the way, hold your guys' favorite charts. We're going to do it at the end.
Okay.
Okay. So fixed income, equities. We talked about the stock market a little bit. Let's talk about how the economy did in 2023. I think that this has a lot to do with the rate hikes and stuff like that. So they hiked throughout the year, and then the first pause they did was when that stuff happened with the banks. Correct? God, time seems so weird now. Didn't that something happen with?
I feel like they did pause in March, but then they kept going.
How many times did they pause this year? Twice?
It looks like from May to August they kind of were paused.
Okay,
that was the only pause. Yeah. And then
that was the only pause.
Q4.
Yeah. Well, they were doing in the how excessive they were being with the hikes changed as well.
Yeah.
They were doing. I think they were doing 25 basis points. Most recently, right? Or were they doing 50?
They were at 25 more recently, yeah. Mm-hmm. Yeah, the 50 bips looks like it stopped at the end of last year, maybe? Yeah.
Well, that's the big theme for a while here has been inflation. Where's the inflation data at now?
Yeah.
Yeah, it's come down a lot. So we don't know, obviously, full year GDP, and that's not what you asked, but big year GDP-wise, I think it's going to finish better than expected. The battle with inflation is going well. Let's see. So through November, CPI at 3.1%, and it peaked out at 9.1%. So it's come down a ton.
Yeah.
And then CPI, which is more important, PCE, which is more important to the Fed, is down to 3.5%, which peaked out at 6.6%. I want to say the target's 2.5% on
2.5
PCE. The one thing that just really hasn't moved is shelter costs.
We'll get into that.
A lot of things have really come down. Energy costs. Energy is in deflationary territory.
Yeah. This is the thing that we've talked about this before, but we have to make this clear. With inflation coming down, this does not mean prices are going to come down. Your grocery bill is not going to go down. Just the rate at which they're rising is decreasing. So the reason they do this is they get it to a target so wage growth can catch up, and then stuff will start to feel less expensive, but the prices are not going to come down. And I think that's what the inflation is, the rate of the growth. Mm-hmm. For prices to come down, there would have to be deflation.
Year rate of growth.
Right.
Yeah.
Right.
So they're just trying to lower because prices are always going to go up. They just don't want it to be as fast as 9% because nothing can keep up. But the prices are never going to go down, at least considerably. Wage growth is just going to catch up.
Yeah. Yeah, and the energy thing is real. That is true. The energy truly did go into deflationary territory where you're actually paying less than you were.
Okay.
So I'm on a fixed bill with RG&E. I've been overpaying all year apparently because my last few months have been half the bill. So I've been apparently just overpaying all year, and hopefully they give me the money back. But Not really like we have a choice to use anyone else, so that's cool.
Right. So how's
You could get solar?
Could do solar. Yeah.
You know, have you thought about that?
No.
So
It's pretty dark out.
the fight against public enemy number one is going great. That's why they're thinking about
Things are looking better.
cutting rates. That's why they're thinking about cutting rates.
Yeah.
How was the consumer last year?
Last year,
2023.
the consumer kept us alive.
Mm-hmm.
Spending.
I love Americans. We'll
Yeah.
spend our money no matter what.
So 67.7% of GDP was from the consumer consumption, spending money.
Great. And then the consumer confidence, it's weird though, because I feel like the consumer confidence, where's that one chart we always look like, is under the average. It was under the average all year. So the consumer doesn't feel great. Was that it?
Let me see.
The consumer, it's fluctuated, but the consumer confidence that they do is still under the average. I thought that was it right there, right?
Well below the average.
Yeah. But they're still spending money. Is that how they feel about the economy or how they feel about the stock market?
I mean, I think it'd be both.
Mhm.
But
I think consumers are angry about inflation.
yeah.
That's driving a lot of that.
Yeah, that's a good point.
Yeah. Yeah. People definitely are feeling the pain. You know, we got through it, but like and it just seems like they might have actually gotten this right, but you know, we ran out of money. So they start cutting or stop raising rates probably at the right time because most of the excess savings is gone now.
Mm-hmm.
And credit card debt has gone up quite a bit. So
That the M2 supply or whatever, that's interesting how for the first time in a long time the money supply has actually gone down.
yeah,
That's not
it usually is really a bad thing.
yeah.
Yeah.
So we're predicting a stock market crash this year.
Yeah, I think the consumer, at the end of the day, like their confidence comes from their grocery bill and their gas bill.
Yeah.
Yeah, yeah,
It
yeah, and how
comes
their
from
and
how
how
they
their
feel
401k
day to
is
day.
moving.
Yep. Yeah.
And you're like the labor force. I don't know if you were just about to go to that. Like,
Yeah.
what are those numbers looking like? There?
Yeah.
Steadily. So we're basically at full
No,
employment.
we were just watching that JP
Yeah.
Morgan thing. What did they say? They were like, we're at full
We're at
employment.
full employment. Yeah, we're at full employment. However, huge spike in jobs added in December, like by way more than expected. I can't remember what the number was, but it was a couple 100,000, 216,000 or something
Yeah.
like that. But the trend is absolutely down for payroll gains. And no one is quitting their job. So that kind of tells you a little bit of something.
But by the way, that's normal. That's what should happen after a rate hiking cycle. The fact that we've had such a resilient labor force during the rate hiking cycle is why people are like so confused, because usually when the first thing to go when rate hikes happen or businesses will let go of their employees, and then that's when a recession starts to kick in. That didn't happen. The labor market was so resilient last year and businesses were fine. They didn't have to do layoffs.
Right.
But also, it happened so quick that the $1 million question is how long? Like, how
Right.
long does it take for that stuff to show up?
Right. Exactly. Yeah. What's the lag time? But then if you're like waiting for it and then it never happens,
Right.
it's a part about time in the
That's
market.
hardest. That's why it's hard.
Yeah.
It's impossible.
Yeah, I think it's pretty clear hiring is slowing down. It is weird, and I don't have the answer for this, that we're at full employment. We still have 9 million jobs open. So
Yeah. I don't know how that works.
is the data wrong? I don't know. But
We need people to have more kids.
Yeah.
yeah,
Mark's helping out with that.
not anymore.
Okay. Real estate.
I got. Ooh.
Yeah. Can you talk about this?
Yeah. So this is fascinating to me. What's happening in the housing market? First of all, you got to talk about mortgage rates.
What are they at right now?
So I think like the average 30 years, somewhere around 7%, something like that.
Nice.
What I'm looking at right here, this isn't as of right this minute, so it's probably a little off, is the average 30 years 7.22. The average 15 years 6.56. For perspective, in 2022, that was the average 30 year was 2.5. So in 1 year, mortgage rates have tripled, right? And you're seeing, so I'm looking at, according to Wells Fargo, traffic of prospective buyers. I mean, the prospective buyers is so far down. the actual sales numbers have like halted. I mean, and it just makes sense. Like why would you sell your house when you have a mortgage of 2% to go get a mortgage at 7.5%? Like it's just really difficult. And but asset prices haven't changed, right?
Right.
So like for you to justify making that purchase, you'd probably want to feel like you're getting a discount on the house, but that hasn't happened yet. So the housing market's just at a standstill. And that's something that like it worries me a lot because it's the largest asset class in the world. And the question is like, what are the trickle down effects of that?
Right.
You know, and that's still hasn't really showed, again, what's the lag on this? Like,
Yeah.
So I don't really know what to make of all that. It's just very interesting information.
What about rents, Mark? Because you said shelter costs are up.
They just have barely come down. That's the problem. Like
It's just crazy.
The stickiest part of inflation right now is just that. But it does logically make sense, right? So if you're a real estate investor and you want to go buy some rental properties and you're paying twice as much now because of the interest rate on it, and really the price hasn't come down at all,
Right.
you're going to have to charge more for rent.
I saw
What are you laughing at?
There's a hilarious account on X, formerly known as
X.
Twitter. Unusual Whales. I keep seeing this tweet that he puts out. I think it's a he. That the housing market's so bad that divorced couples are still living together.
Well, actually, he did post something yesterday about the real estate market. Let me see if I can find it here. Can't remember what it's called, but
You get all your news from Unusual Whales. Like you could literally just get all your news.
Yeah, it's pretty interesting.
I'll find it. Just give me a second.
I thought about making my favorite chart his chart
Really?
about politicians' investment returns.
Oh yeah, he's big. I think that might be his pinned tweet about all
That's
like
his
the
like thing. That's what made him like big.
Wow, he tweets a lot.
But
That's interesting. So
the housing
no
market
movement really on the housing market either.
is just at a standstill, and it makes sense. Question is, what's the downstream effects of that?
Right.
And if the Fed does cut rates fast, maybe things will normalize there again. But it wasn't really normal either before that. I mean, the fact that your house, even in the country of Rochester, New York, went up 25% in 2 years or whatever, it just doesn't really make sense.
Yeah.
So,
any other pieces on the economy that you guys want to talk about?
I can't remember what the hell it's called, but
so to recap some of that, like GDP strong, labor market's still pretty strong, although trending down.
Yep.
Wages have been resilient.
Yep. Consumers are still buying.
Yeah.
Businesses are
Housing
fine.
market's not great.
found it. A bill was introduced to the Senate at the end of 2023, the End Hedge Fund Control of American Homes Act, that would force investors to sell off all the single-family homes they own over 10 years and eventually ban hedge funds from owning any single-family homes entirely.
Yeah.
I don't think we really know like hard facts on like how big of an impact it's having, but it certainly is having an impact. So that could be something that actually helps the housing market. Is if hedge funds have to unload these single-family homes.
I don't understand how that's allowed.
What?
That hedge funds are buying single-family homes.
It's essentially BlackRock. They own so much.
Yeah. Although I did listen to a podcast episode on that, Compound and Friends, where they had an expert come on in the real estate market, and he had said that it's not really like, it sounds bad, but it's not happening like as much as you think it's happening or something. But it just shouldn't be allowed.
There's just no room for it anyway.
Like
whether it's that bad or not, we can't have them. People who can buy everything in cash?
Right. Why would we want that? It doesn't make sense.
So this is, I would say, okay, so, 2022, bad year. 2023, good year. 2024, let's talking about investing principles. Because what do you think? No one knows. As we just said, we proved it to you that no one knows. So what should you do in 2024? These are the investing principles. This is what you should be. This should be your Bible when it comes to investing through, especially like times like this.
Yeah.
So
where do you want to begin?
I'm going to start off. I'm just going to use some data from one of the charts there, but this is only through December 5th, so it's changed a little bit. But through December 5th of 2023, the S&P was up 18.97.
Which one are you looking at?
The effects of missing the best days.
Oh yeah, okay.
So it was up 18.97 through December 5th, excuse me. If you miss just the 5 best days in 2023 alone, that return goes down to 7.9. You miss the 10 best days, now you're negative. You're at negative 0.68. So from an investing principle, number one that I think is most important is just to be invested.
Stay invested.
Don't try to time the market. Time in the market.
And like we always talk about, the best days often occur right around the worst days.
Yeah.
Yep.
And so it feels like you want to get out, but that's usually the big mistake.
If you missed 5 days, you cut your return in more than half.
Right.
In 1 year.
It's crazy.
Just in 1 year.
Right. That is a crazy chart just in 2023. So we say stay the course.
Yep.
Get invested, stay invested.
Yep.
Now, what would be those? So like we're talking a lot about, in the beginning, we talked about the indices like the S&P 500, the NASDAQ. Like a lot of people are like, okay, I'm going to go buy an S&P 500 index fund, or I'm going to buy QQQ. I'm going to buy the NASDAQ. And that's fine. Like index funds are great. We like them. We use them. Why necessarily is that not a good plan for your finances? Let's talk a little bit about asset allocation and diversified portfolio.
I think a good example is like you were talking about basically commodities. Like you said, utilities and energy were the only two asset classes down in 2023, but they were the best performers in 2022, right?
Mm-hmm. Commodities were up 16% in 2022, down 7.9 in 2023.
Right. So that's your example is not really helping with that, but like not owning commodities in 2022 would have been a horrible thing, right?
And then REITs.
You just never know. So the best performer in 2022 ended up being the worst in 2023. The best performer in 2023 might have been QQQ.
Yeah.
Might be the worst in 2024.
Exactly.
So again, it comes back to we just don't know. So you got to be diversified.
Yeah.
That's the discipline of this whole thing.
So the quilt, we love the quilt for asset class returns in 2023. Large cap was 26.3. The diversified portfolio or asset allocation was 14%. You're listening to this, you're like, okay, why would I do the asset allocation when I got a lot less money? The asset allocation smooths out the ride. If you think that you can be invested into large caps or the S&P 500 for an entire year when X, Y, and Z is happening, you don't know what's going to go on. If you think you can do that, which you usually say is 1% of people, go do it because it's the better return. Asset allocation gives you a plan and smooths out that ride.
Yeah. Yeah. And we, in an episode previously, we showed an example. I remember we talked about, imagine you had $1 million in the S&P 500 going into 2008. At the start of 2009, if I'm remembering correctly, you would be down to $500,000 in 1 year.
Yep.
Are you really disciplined enough to keep riding this thing out?
Right.
And that's the point. And I think a lot of times, like we talk about this all the time. If you've got a small amount of money, you don't care. But when you got a big pile of money and you're feeling that wave, you care a lot more. So that's why you have to do this. You got to smoothen out the ride. And we just don't know. If you look at the quilt, and Steve will put that up, it's so all over the place. Like usually the previous year's winner is the next year's loser. That's usually just kind of how it goes.
Right. But the asset allocation, look at that. Look, middle of the road. It's never going to be the best, never going to be the worst. Which one do you want?
And it helps you to not miss I think that's the most important part.
Yeah.
Is it helps you to not miss the best days in the market.
Yep. That is probably, that goes in with timing the market. That is literally the worst thing you can do. Missing the best days, timing the market, the worst thing you can do.
Yep.
If you start thinking if you think to yourself, is now a good time to be invested, you're already starting to lose it a little bit.
That's true.
You know what I mean? Like we always answer those questions.
The answer is
like,
always yes.
Is now a good time? Should I wait? Well, you're already lost if you're asking those questions.
Don't waste my time with that question.
So that's our answer for 2024. That's not fun, but you're not clicking on this video because you know we're going to give you a stock to invest in. We're going to tell you how to fail safe your financial plan.
So I'm looking at this 44-year chart, and what was it? 75% of the time, I can't remember what the exact stat is on it, but 75% of the time over the last 44 years, the S&P 500 finished positive. 33 out of 44 years. Average intra-year decline over that period of time was 14.2%. So 75% of the time it finishes positive. I don't think there was a year that it wasn't down.
Right.
At some point,
Yeah. So how's your index fund is going to do great at the end, but in the middle, are you holding the conviction?
Yeah, and if you don't believe us, just go next week. Just let's do it for 1 week. Just go watch the stock market each day next week and tell me what you learned.
Mark will do it with you.
Tell me what you learned from
He'll watch it every day with you.
I mean, last year was actually a really good example of it. The market was down 10% at one point and finished the year up.
Wait, I asked if it was down at all. You said no.
It was down 10% at one point.
Oh, wow. I didn't even know that.
Yeah.
Because I got asset allocation.
I mean, 2020, I don't really think we should use that example, but it was down 34% and finished the year up 16.
Yeah.
Okay. Favorite charts.
Ooh.
Are you going off the cuff? Like, is it not on the PowerPoint your favorite? Sure, you're going to choose one from Unusual Whales.
Go to him first.
Mark, you got a favorite?
I was going to go last.
Okay, I'll do my... I'll do my... one?
No, I thought mine was... I have multiple, so...
No, you can only have one, Mark.
I know, but that's why I was going to go last, because I have more than one.
My favorite one is the quilt, because you can literally show this, like, because I love index funds, but that is probably one of the biggest things that people say is like, why wouldn't I just buy an index fund? You show them this, and then you give them the example of, okay, you're down X amount on your index fund in the middle of the year. Are you staying the course? If they could say yes, then I'll back off. But if they say no, I'm going to show them this chart. It's just perfect. Look at asset allocation from the volatility all the way.
Yeah.
Look at look at the volatility. It had the third lowest volatility out of every asset class besides cash and fixed income from 2009 to 2023.
Yeah. I mean, if you hate being wrong and you don't care about always being right, you should be asset allocated.
Say that's it. No, that is great.
Wait, say it again?
Yeah, say it again.
If you hate being wrong, but you don't care about always being right, you should be asset allocated.
Wow. Did you just come up with that?
I did.
No, I've heard you say that before.
But that was fresh right there.
That was good. Yes. That is perfect.
Nice.
Okay, mine's the quilt.
All right.
I'm surprised you don't have one from like Twitter, Nate.
I told you I was going to do the politicians returns, but you wouldn't let me throw that in here. This is not, apparently we can't talk politics here. My chart, and I don't really know what to think about this, but I just find it so interesting, is the Magnificent Seven. It's crazy to me.
Oh, yeah. We didn't really talk about that. The weightings.
So just like the S&P, so Mark, you know this stuff better, so speak on this, but the S&P 500 is the 500 largest U.S.-based companies.
Mm-hmm.
And it was up whatever percent last year, 24% or something like that. But like, how much of that came from just 7 companies?
Well, I'm looking at the top 10, so that's close enough, right?
Sure.
87% of the return came from just the top 10.
87% of the return came from those companies. Do you have data on what the rest of the other 490 did?
Mm-hmm.
What is that?
So the top 10 was up 57% last year.
And this is Amazon, Google, Microsoft, NVIDIA, Tesla.
I'll give you them right now.
What is it, United Health?
Apple, Microsoft, Amazon, NVIDIA, Google, Berkshire, Google again, Metal. I don't know what XOM is. United Healthcare, and then Tesla.
Yeah. So that is abnormal.
Makes up 80% of the return of the index.
Mm-hmm. Yeah. You know what it makes me feel like is that we should buy the other 490 this year.
So the other 490.
If you're, I'm guessing like Spider. What are some of these big ETF?
Well, there's plenty equal weight.
No. Hang on. Oh. Spider. Who are some other big ETF?
First Trust is. They have what you're talking about. The NASDAQ.
You don't know what I'm.
X.
I want. Oh, where they take out the top 10? Wow.
Yeah, obviously.
Damn it. I thought I had a good idea. I figured they're listening to the pod.
But do you want that?
Yeah.
Yes. So
top 10 stocks were up 57%. The other 490 were up 7%.
Oh.
Can we do this? This would be interesting. Steve, you're going to have to be the one that remembers this. We should pay attention this year to see how the 490 do versus those 10. Because coming back to investor behavior, every average person is be like, well, I just want to own those 7 to 10 companies. Yeah. I mean, they're crushing it. If you listen to this pod, we're telling you to do the opposite.
Well,
So can we track that moving forward?
Dude, all 490. I mean, they got to have a year at some point. Right?
They're due.
it is kind of interesting, and this kind of makes sense here. If you look at like communication services and tech, which are all those top 10, they have the highest percentage of cash. So makes sense. They didn't have to go out and borrow.
They're very profitable.
Yeah. So they had a ton of cash, ton of free cash flow, and they didn't have to go out and borrow money. So if this like higher for longer were to keep going higher and stay higher for longer, eventually it would get to them. I don't think it's going to.
There's now 7 companies, right, with over $1 trillion in market cap.
Something like that.
I was hoping you were going to do like a AI's effect on the stock market chart. Because that probably...
These are all pretty much AI companies.
Dash Capital's an AI company, Nate. All right, so Nate, you did the concentration of the S&P. Mark, favorite chart.
Did we cover all that? All? Yeah.
Yeah.
I'm gonna go with. It's tough between the two.
What are you putting your name on, dude? I mean, like, this is...
It's gonna be a diversification one.
I knew it.
Which one do you think? Do I go with this
The time diversification, volatility of returns.
or this?
I like the...
This
I
one's
think
too
you
hard for
should
people
pick
to understand.
something like sexier.
No, the... What do you mean? You don't like the quilt?
I mean, this is
Mark. This is what Mark would choose.
This is just so important, but I really do like this.
All right, portfolio diversification.
But I just don't think it's as easily understood. So we'll go with this.
Okay.
Which is what? Which one?
The portfolio diversification. It is really important because people are just flat out wrong about this stuff.
Talk about it?
It's not. That's the one he's not choosing.
Right.
Oh, you're not choosing.
He's choosing
So what are you
time
choosing?
diversification and volatility of returns.
Okay, talk about it.
So when you're looking at this chart,
It's on the
do
screen.
I need to pretend
He's
that
gonna
I
have it
know?
on
It's on the screen.
He's gonna
Got it.
get it up there.
No,
We
this
have
is new to
a
me.
great
This is new
podcast
to me.
editor, dude.
This is just super straightforward here, guys. It just shows that if you have all stocks, all bonds, or a blended portfolio of 60% stocks or bonds, it shows your range of outcomes over given periods of time. And if you know your time horizon, we went back to invest. We were talking about investing principles, so I'm staying on that course here. If you know your time horizon, there's not a reason to try to time the market, getting in and out of the market. You can clearly see here, if you hold stocks, I'm going to go with stocks for a 10-year period, the worst outcome since 1950 was a negative 1%. The best, 19%. Average rate of return over the long haul, 11.2%. If you don't want to risk losing money at all, outside of potentially a downside of 2% over a 5-year period on bonds, you can be down as bad as 2% in a 5-year rolling period. 10 years, never negative. The 60-40 portfolio, never negative in a 5-year rolling period since 1950.
Mm-hmm.
If you got 5 years on your plate, your time horizon is 5 years, go in a 60-40 portfolio and know that this is probably going to be true.
Mm-hmm.
Right.
You know what I think is crazy is like a lot of times. I just had this conversation. I just came from a review meeting with a client, and they were concerned about the market, and I think a lot of people sometimes think of investing on the stock market like gambling, but it's not even close to a comparison. Right. It's not even sort of a fair comparison.
No.
Like at 73% of the time, the stock market is going to be positive in any 1-year period.
Right.
So think about those odds. Like gambling is nothing like that.
No, it's just become that because of Robin Hood.
Right.
You can literally gamble on stocks now so easily.
Right.
But that's not what the stock market's supposed to be. Like,
The
that's not
S&P
how you're supposed to
500
invest.
is up 3/4 of the time in any given year.
Mm-hmm.
And in this Y charts chart, this one's interesting. What do you think the percentage of the time, Steve? I'm going to ask you this because Mark probably knows. What percentage of the time is the S&P 500 positive in any 1 month period?
Oh, I don't know.
What do you think?
Wait, it positive in any 1 month period?
Mm-hmm. From 1950 to today.
It's got to be over 50%.
60% of the time in a month.
That's not gambling.
That ain't gambling. Those odds are good.
That is good.
No. Yeah.
So,
but if you go talk to the smartest investors in the world, none of them are looking at a 1-year time horizon.
no.
right? No one is gambling with their stock picks.
But their eyes are watching it in that
Right,
short period
right.
of time.
There's times when if you're picking individual stocks, there's times when you got to walk away. There absolutely are.
Right.
Yeah.
But
That's probably
this
the
is
hardest
easy.
part.
I'm looking at this. This is easy. Have a nice blended portfolio and stay the course.
Yeah.
And
if you want to be down way less and just up a little less, 60-40.
Right.
Okay, Mark, great choice. I think we had some good. That was weird. I thought you would have picked the one Mark did, and Mark would have picked the one you did.
Yeah.
I'm trying to do this.
I'm an entertainer.
No, the other one is definitely my favorite chart. The index concentration is definitely my favorite chart.
You mean portfolio diversification?
No, the S&P 500 index concentration is definitely my favorite.
Yeah,
chart.
it's amazing.
It's unbelievable. I mean, it's.
Can we throw in a bonus chart? No.
What chart do you want?
Wait, actually, one last thought on this. I think what's really, really crazy right now is that the S&P 500 is actually priced very fairly, which is a good.
I was hoping we were going to talk about that. What do you mean by that? Because the average person doesn't know what you mean when you say priced fairly.
So it's priced right at the average of where it has been historically. Was it over a 20-year, 25-year, whatever it was?
Where are you saying the PE ratio?
Mm-hmm. Is that what it is? Is it 20, 25?
So the price compared to company earnings is right on par with what it's been for the last 20 years.
Right.
Which is when you.
So even though we're basically at all-time highs, and that's again coming back to investor behavior, the skeptics out there are looking at where the market's at and they're thinking, how are we at all-time highs? And you got the housing market's dog crap. You got all this bad news that's potentially coming out. What's going on? Yes, it's at all-time highs, but people need to understand, and this is why I want to throw in a bonus chart about the amount of debt that exists right now. People need to understand that if we're at all-time, we should always be at all-time highs.
Mm-hmm.
That means that the world's growing. And if the world isn't growing, we got way bigger issues.
Right.
And that's the thing that's amazing about humans is we're always trying to improve. So like if we start going down, like that would be a very bad thing. Mm-hmm. And I think it's funny. I just want a bonus chart. Can I get a bonus chart in?
Do you have it?
Yeah, I got it. The charge it chart I think is interesting. So US, like you're going to hear these things. People are hearing these things all the time. U.S. credit card debt's at all-time highs. It's over $1 trillion. Mortgage debt at its all-time highs, over $12 trillion. Auto loan debt at all-time highs at $1.6 trillion. Just U.S. household debt, right? The summary of all that is at all-time highs. Of course it is. Right. It should always be going up.
Right.
Why don't people get that?
Right.
If debt is actually going down, it actually means the economy is going to be slower.
Right.
People use debt to buy
100%.
things. And as your wages are growing, you get access to more debt. Mm-hmm. So of course we're going to have more debt. It sounds like a scary number, but I feel like it gets blown way out of proportion. People try to pump it as like this narrative, like the thing's going to crash. No, this is just how it works.
This is how America is.
If debt goes down, then things are going to slow down, and that's actually bad.
I don't know if they still have this chart with the lending standards, but a big story last year, and it is true that the lending standards and banks have been tightening up lending standards. They don't have it in here. That is concerning. So what Nate's talking about is debt growing makes sense. It's a good thing. It means that we're growing. If lending continues to tighten, there's not money being given out. That is scary.
That's a much better leading economic indicator than looking at U.S. household debt.
Right.
Now, it's not always good to see
like delinquencies. That would be bad.
That would be
stuff.
Bad. Stuff like that is what people need to be paying attention to.
Mm-hmm. Yeah, it's like if you're taking on debt and it's for an active purpose, something that can outpace the cost of the debt, that makes sense. But like taking on debt to go buy a pair of sneakers doesn't make sense.
No, right. That's what I was always worried about with the huge emergence of buy now, pay later. I was worried about that, but those companies are killing it.
They got in some trouble for a minute there.
I like that bonus chart. I'll put that up. Make sure you save that because I got to put that up.
It's in our Teams channel.
Oh, it is?
Oh, yeah.
Okay. All right. Yeah. Do you guys have any last minute thoughts here? This was a great review of 2023.
Do you guys think international is going to have its time to beat U.S. stocks? It's been a long time, guys. It's been since...
I don't know. There's a lot of
I'm too scared.
There's
too much stuff going on. There's too much stuff going on.
You see what's going on in Germany with the farmers?
No.
Is that where they're
crazy.
dumping the shit all over the roads? Yeah.
What?
It's so funny.
Like I guess Germany is like they're increasing the tax on farmers like a crazy amount to try to for ESG reasons. Like they're basically
Yeah.
Again, let's not get into
Government
politics.
overreach, man. Hawaii, they said they banned fireworks, and you see the whole freaking shoreline was just all just ripping off fireworks. It's just awesome video.
So I would say I would not bet on international,
Me neither.
but you got to have them in your portfolio because you got to be diversified.
It's got to happen at some point. They are so cheap. The dividend yield's better. They haven't outperformed the U.S. since like 2006.
That's crazy.
Really.
But yeah, so it's been 14 years of U.S. outperformance. So I guess less than 2006. Before that, were 7.2 years of international outperformance. Maybe we're going to get it here soon. I think the exposure to it, like Nate said, you got to get into it. You got to be holding it because eventually it should have its time. Yeah. This is another argument for the quilt, for diversification. You don't always have to know which asset class is going to be perfect. By being exposed to them all, you're going to have a smooth ride. You're not always going to be right. You're never going to be wrong. You're going to have some of the best performers in there, and you're going to have some of the worst performers in there, but that's okay. It's a good thing to be, like, through rebalancing, it's a good thing to be buying the worst performers when they're down, and selling the best performers when they're up. So
that's good. Dude, that's like a commercial. Rest in peace, Charlie Munger, by the way.
Yeah.
Oh, yeah.
Legend.
Great one. Ever heard of him? All right, we got to get out of here.
Yep.
All right, guys. Successful first podcast episode of the year, right?
Yeah. I'd say so.
Word? Yeah. All right, thank you for listening and watching the Max Your Dash podcast. We will catch you guys in the next one.
Securities offered through Securities America Inc., member FINRA SIPC. Advisory services offered through Security America Advisors Inc. Dash Capital Advisors and Securities America are separate entities.